Imagine a policy change that doesn't make headlines but directly affects how state governments raise money, how insurance companies invest long-term funds, and how institutions plan for future payouts. That rule just changed. And while it might seem minor, it holds important implications for India's financial system. If you're someone who wants to understand how behind-the-scenes policies quietly shape money, flows, savings, stability, and investment planning, then hit the like button, subscribe to this channel, and let's make finance simple together. Now let's decode what's really going on with this new rule from the Reserve Bank of India, or RBI. In June 2025, the Reserve Bank of India extended the STRIPS facility for state government bonds. STRIPS have been available for central government bonds in India since 2010. The recent RBI move simply extends this tool to state bonds. The practical effect is to create new zero-coupon instruments out of eligible state bonds, potentially deepening the market. Now, I know, STRIPS sounds technical, but don't worry. Let me explain it simply. STRIPS are essentially zero-coupon bonds made by peeling off a regular bonds payments. Imagine you lend your friend 1000 rupees and every year they give you 70 rupees as interest. After 10 years, they also return your 1000 rupees. That's how a normal bond works. You get small payments regularly, then the full amount at the end. But now imagine instead of waiting every year for 70 rupees, you break that loan into separate parts. One part is just a promise to pay you 70 rupees in 1 year. Another part pays 70 rupees in 2 years. Another pays the 1000 rupees after 10 years. Each part becomes a separate mini bond. That's what STRIPS are. The full name is Separate Trading of Registered Interest and Principal of Securities. STRIPS let you separate each interest payment and the final repayment into their own bonds. These mini bonds are called zero coupon bonds because they don't pay anything regularly. They give you one single amount at a specific future date. They are sold at a discount and redeemed at full value. So why does this matter? Because insurance companies and pension funds love this idea. They have to pay out money 20, 30, or even 40 years from now. With STRIPS, they can buy a bond that gives them exactly the amount they need on that exact future date, without worrying about reinvesting smaller payments over the years. But here's the twist. The RBI allowed STRIPS only for state government bonds that have 14 years or less remaining. That's a limitation. Because most new state government bonds are for longer periods, like 20 or 30 years. And that's what life insurers need. So now they're saying RBI should consider extending STRIPS to longer maturity bonds too. Why does this small change matter? Think of it this way. If you're planning a wedding in 20 years and someone offers you an envelope with the exact amount of money you'll need on that date, that would simplify your planning. That's how STRIPS help insurance companies. Without STRIPS for longer bonds, they're forced to reinvest proceeds multiple times, which introduces risk and complexity. Let's go a little deeper. How do STRIPS work in real life? If a state government issues a bond for 100 rupees with an interest rate of 8%, that means they'll pay 8 rupees every year and 100 rupees at the end. With STRIPS, each 8 rupee payment becomes its own mini bond, and the final 100 becomes another one. These can be bought and sold separately. Now, how are these STRIPS created? Investors or banks use a system called e-Kuber, which is the RBI's digital platform for handling government securities. If someone has a bond that qualifies, they can request the RBI to split it into STRIPS using e-Kuber. It's like going to a shop and saying, "Can you please split my big chocolate bar into smaller pieces so I can eat one every year until I need the last big piece?" But the RBI has set rules. Only bonds that have at least 1000 crore rupees outstanding, a fixed interest rate, and less than or equal to 14 years of maturity can be split. So even though STRIPS are useful, the current restriction limits their availability. Insurance companies argue that if this rule stays, they won't be able to use STRIPS for many of the bonds that match their long-term liability needs. That could reduce demand for state government bonds and shift institutional investments elsewhere. In summary, strips are tools that help investors match money with future obligations. But the RBI's 14-year maturity cap restricts their utility. This isn't about dramatic change, but about improving precision in long-term financial planning. So, the next time you hear about a bond market regulation, remember, it may not sound exciting, but it's part of how large-scale financial systems quietly function. If this video helped you understand something new, support us by hitting like, subscribing to this channel, and sharing the video with others who want to make sense of how the economy works. Because when finance becomes simple, everyone makes better decisions. See you in the next one.